Well, hi there, everyone. Welcome to Momentum Finance. Today, we are going to be looking at two undervalued dividend stocks with safe dividends yielding over 8% dividend right now, which is just remarkable. And we're going to get into it right away. The first company for us to review is a company called Majillion Midstream Partners. It is traded on New York Stock Exchange with ticker symbol MMP. Majillion Midstream Partners currently pays a dividend yielding 8.69%, just remarkable. And in fact, the dividend is considered to be safe. The company is a large cap company with a market capitalization of $10.5 billion. The last trading price for Majillion Midstream Partners was at $47.29. From a stock volatility perspective, Majillion Midstream Partners has a volatility beta measure of 0.70, which is considered to be less volatile than the overall stock market. Beta is a measure of volatility, and a company's stock with beta of under 1 is suggesting to be less volatile than the overall stock market. Majillion Midstream Partners is, in fact, one of America's largest master limited partnerships, and the firm's pipeline systems primarily transports refined petroleum products such as gasoline and diesel fuel from refineries, helping them eventually reach gas stations, truck stops, airports, and other end users. The rest of the business consists mostly of oil pipelines. Majillion generates most of its cash flow, in fact, from fixed rate transportation and storage contracts, minimizing the firm's direct exposure to commodity price fluctuations. Their operating pipelines is an attractive business for several reasons. First, a few companies have the financial capital and industry relationships to provide end-to-end infrastructure. And additionally, there are few substitutes for pipelines thanks to their cost efficiency and safety, as well as the geographic constraints. Oil and gas, for instance, formations tend to be in hard-to-access areas. Most of the products moved by Majillion's pipelines are, in fact, non-discretionary in nature, resulting in predictable demand patterns for the company and its services. Majillion boasts the longest refined products pipeline system in the US and accesses around half of US refineries refining capacity, making it an especially attractive partner for its customers. All right, moving on, we're going to take a look at the company's key metrics when it comes to their dividend payment. Looking at their payout ratio, they have a payout ratio of 86%, which is a little bit edging higher for the MLPs, but their forward payout ratio is a little bit lower at 84%. Ideally, of course, we want to see the payout ratio hovering under 60% or around that. But again, for this type of company and given the solid, dividend track, that's not going to be a huge concern for us. In fact, look at that. They've been paying their dividend without reduction for the past 19 years, and their track record when it comes to paying dividends, even during the recessions and market crashes, has been kind of very positive. Look at that. During the 2007-2009, not only they did not stop their dividend, but rather they increased their dividend payments. And this is despite the fact that during that time, their total sales actually declined. During the recession for them was down by about 25.3%, which is below average growth during the 2007 to 2009. And the stock's return during those years, during the recession times, was down by 30%, which actually was better than overall S&P 500's decline of 55% during 2007-2009. So in that sense, they are doing okay. Moving on, if you look at their dividend payment track over the past 20 years, the graph shown here, you can see their annual dividends per share, how they've gradually actually consistently grown that. In fact, over the past 19 years, as we talked about it, they've been paying uninterrupted dividend for the past 19 years and managed to grow their dividend year after year for the past 19 years as well. The company pays their dividend on a quarterly basis, and it's paid in the months of February, May, August, and November. And currently, their annual payout per share is at $4.11. Looking at the valuation for Majillion Midstream Partners, their current dividend yield of 8.69% is 39% above their own 5-year average of 6.27%, which indicates that now could be a reasonable time to invest unless you believe that the company's outlook has weakened. Furthermore, the company's forward price to discounted cash flow, or P/DCF ratio of 9.7 is below their own company's 5-year average of 12.3. In other words, the stock looks cheap compared to how the market has valued it in the recent years. However, if we compare their forward price to discounted cash flow for the company to that of the industry, the sector for energy, you'd notice here that it is above the ratio of 9.7 for the energy sector, which is actually at 6.4. So 6.4 is the price to discounted cash flow for the energy sector. And this usually happens if investors are especially optimistic about the firm's strong growth profile. As a result of that, willing to pay the price to get their hands on the stock, given the stock's perhaps superior business model or the durability of its earning stream. And in fact, in this case, you see the company has been paying its dividend uninterrupted for the past 19 years. But you have to, of course, look at it with some caution because you're paying some premium here, and the stock's premium multiple could continue re-rating lower towards the sector average if the company's outlook, for example, for profitable growth was weakening, and the investors decided that, you know what, this is not worth the premium that you're paying for, and as a result, it could impact the stock's price. But if you believe that MMP's long-term prospects are still good, as they vary in recent years, and the dividend remains solid, then stock could be at a reasonable entry point. And we're going to take a look at that both in terms of the analyst estimates as well as some other financial metrics such as their total sales and in terms of their other metrics that you're going to take a look at. If you look at their price range for this company, for Majillion's Midstream Partners over the past 52-week price range, you notice that the lower price for the stock was at $33.63 and the highest was at $53.53. The stock is now trading closer to its 52-week high price at this time. Let us take a look at a number of other financial metrics. For example, we're going to take a look at total sales at the top right corner of the page. You notice that the company's sales has, for the most part, gradually increased year over year over the span of the 10 years. There are some years whereby there you've seen some decline. For example, 2014, we had high sales for the company, but then the following years it started to decline. Again, 2018, it happened, and same pattern, a little bit of that cyclicality, but as you see here, the last 12 months for the company is showing to be $2.52 billion in total sales, which is higher than the 2020 year. As for the company's return on equity, which is actually measuring how many dollars of a profit a company earns for every $1 shareholders have invested in the firm. And obviously, the higher return on equity, usually the more pleasant this number is. The last 12 months is showing to be 37%. And according to Warren Buffett, he tends to favor firms that have consistent mid-teens return, which indicates they could possess actually an economic moat as a result of that, maintaining that return on equity, decent return on equity. And in terms of the shares outstanding for the company, ideally, we would like this number to be gradually decreasing, the company buying back its shares and whatnot. In this case, they have kind of maintained their number of shares over the past 10 years. Currently, for the last 12 months, they are showing 224 million outstanding shares, which is, again, lowest compared to any of the last 10 years, and as a result, positive sign. We are going to take a look at the stock price and its volatility over the past several time periods. The graph on the left is actually showing you the 5-year stock price return. So you notice here, for instance, for the company's stock, the past 5 years, it had gone down by 32% plus. So that's a negative return. In fact, the stock price not only appreciated, but also declined. That might not sound quite good, but it's not always that bad of a story. For instance, if you look at the year-to-date return for the stock, it's actually showing to be positive 14%, 14.31% year-to-date positive return. So the stock, while it has been down greatly over the past 5 years, you have to count in the really high dividend that they are paying. And at the same time, it is actually not always such a bad story if you look at different time horizons. So that's something that you need to be mindful of. With that, let's take a look at the stock price prediction according to analysts. According to analysts on Simply Wall Street, the stock price, the fair value for the stock price would be at $61.31, which, if it holds true, the stock is actually 22.9 or close to 23% undervalued. Similarly, for tip ranks, there are 8 analysts valuing the stock, and 3 of them have a buy rating and 5 of them have a hold rating, giving the stock a moderate buy rating at this time, with the average price target for the stock at $52.38 within a year time frame. That shows an upside of 10.76% for this stock. The lowest price target for the stock, according to analysts, is at $50, and the highest being at $56. All right, with that, let us move on to the second company that we promised, having a dividend, safe dividend of over 8%. This company is no other than Enterprise Products Partners, with ticker symbol EPD, traded on New York Stock Exchange. Again, another energy company in the energy sector. It's an oil and gas storage and transportation, similar to the other company that we just talked about. It has a safety dividend score of 65, considered to be safe, and does pay a dividend yielding 8.34%. The last trading price for EPD was at $21.58, and the company is considered to be a large cap. It's $47.2 billion in market cap. In terms of the stock price volatility, the stock has a beta of 0.84, which is less volatile than the overall stock market. As for Enterprise Products Partners, since its creation in 1968 as a simple wholesale marketer of natural gas liquids, NGLs, Enterprise Product Partners has grown into one of America's largest midstream master limited partnerships that services both producers and consumers of NGLs, natural gas, crude oil, refined products, and petrochemicals. The MLP's service include everything needed to get raw fossil fuels from the producer's wellhead to the end of consumer in a ready-to-use state. And more specifically, this process involves gathering, treating, processing, storage, and transportation. Moving on, if we look at the key metrics for the dividend, the company has a payout ratio of 60, which is very low, and in fact, it's very desirable for us in that sense because it has a lot of room to grow its dividend. It also has a forward payout ratio of 61%. Again, it's a positive sign, giving the company a lot of room to grow its dividend amount. In terms of the dividend streak, the company has been paying its dividend uninterrupted for the past 22 years. And when it comes to their performance from a dividend perspective during the recession of between 2007 and 2009, they not only did not stop their dividend, in fact, they continued to increase their dividend payment. Again, remarkable. In terms of their sales during that time, the company's sales declined by 28.1%. And when it comes to the stock's performance, their stock price was down by about 37% during the recession time, but it was better than the S&P 500's negative 55% stock return during the 2007-2009. That's something for us to be mindful of. In terms of the dividend history, the trend for the past 20 years is shown here. You'd see the company has been also paying its dividend uninterrupted for the past 22 years. And in all of those years, they have been increasing the dividend year after year. The company does pay its dividend on a quarterly basis in the months of February, May, August, and November. And currently, they do pay an annual payout of $1.80 per share of the EPD. Enterprise Products Partners, ticker symbol EPD, they have their current dividend yield of 8.34%, which is 30% above its 5-year average of 6.40, indicating that the company now, it could be a good reasonable time for you to invest unless you believe that the company's outlook has weakened. Furthermore, the company's forward price to discounted cash flow P/DCF ratio of 7.3 is below the company's own 5-year average of 10.4. In other words, the stock looks cheap compared to how the stock market has valued it in the recent years. However, EPD's forward price to discounted cash flow ratio of 7.3 is still well above the energy sector similar ratio of 6.4. And as we talked about earlier, it could happen if investors are especially optimistic about the company. But of course, you have to treat that with some caution and do your own due diligence and research. We're going to be taking a look at a number of other financial metrics. But before we're doing that, let's take a look at the 52-week price range for the stock. The lowest price in the past year for the stock has been $15.33, and the highest at $25.44. The stock is hovering about halfway there, but a little bit closer to the 52-week high price. Looking at a number of other metrics, for example, the company's total sales, you'd see for the most part a little bit of that cyclicality, but the stock, the overall sales for the company has declined definitely compared to where it was back in 2011 or 2012. The last 12 months, the total sales for the company is showing to be at $32.6 billion. From a return on equity perspective, it is definitely in 15% range, between 15 to 20% range, and the last 12 months is showing to be at 15%. It is positive, according to Warren Buffett, as we talked about. You'd like to see mid-teens there. In terms of outstanding shares, ideally, we will want to see the number of shares declining here. It's not the case. In fact, the company is gradually issuing more shares, and the last 12 months, it has an outstanding shares of 2.2 billion shares. Looking at the stock price return, the past 5 years, the stock price was down by 18.84%. But the year to date is not the same story. In fact, year to date, the stock price is up by about 12%, 11.87% to be exact at this time. Moving on, if you look at the stock price predictions and stock price expectation for future, currently, according to analysts on Simply Wall Street, the stock is about 40% undervalued, and they're having a fair valuation for the stock at $35.75. And according to Tip Ranks, there are 6 analysts reviewing the stock, all of them having a buy rating. As a result, the stock showing an overall strong buy rating at this time. The analyst expectation average price target for the stock is at $28.67. If that holds true, that shows an upside of $32.85 from a stock appreciation perspective, not considering the dividend that you're getting paid here quarterly right now, actually being an annual dividend of over 8%, again, which is remarkable. The lowest price target for the stock is at $27, and the highest, according to analysts here on Tip Ranks, is at $30 at this time. Well, there you have it, folks. A quick look at 2 undervalued stocks right now in the stock market that do pay a safe dividend of over 8%. This is particularly of interest, I believe, for value investors and investors who are interested in dividend income and passive source of income for your portfolio by adding quality dividend stocks to your stock investment portfolio. I hope you found this video beneficial. I did a lot of research to put this video together, and I really appreciate if you can give this video a thumbs up and perhaps share it with someone who might benefit from the video as well. Don't forget, of course, to subscribe to our channel. Here on Momentum Finance, we post every week several videos about investing in the stock market, including dividend stocks, growth stocks, and penny stocks, as well as ways to reach financial freedom. With that, thank you so much for watching this video, and I hope to see you next time.